Joining us right now is Allianz Chief Economic Advisor, Mohamed El-Erian. Mohamed, it's good to see you. Thanks so much for joining us this morning.
Thank you, Maria.
So what do you think about this latest effort to repeal Obamacare? If it fails next week in the Senate, how will that weigh on markets? What's your take in terms of this policy coming out of Washington and how it impacts stocks?
I think, Maria, that the markets are less focused on healthcare reform and much more focused on tax reform. So the question in the marketplace is, will this facilitate or complicate tax reform? And that's a really uncertain question, and people are just waiting to get indications out of Washington.
Yeah, I know. And the tax package, you would think, would move the needle on economic growth, right, Mohamed? And yet right now, the triggers or the catalysts for this market have been just a fundamental backdrop that seems to have improved quite a bit.
Yeah, there's been three triggers. One, as you say, the overall context of economic growth has improved, mainly on account of what's happening outside the U.S. Two, the markets are very comfortable that the Fed and other central banks will continue to be supportive. Three, there's a lot of cash sitting on balance sheets of companies, and that gets put back into the marketplace. So those three things have been pushing stocks higher and higher. And the hope is you're going to validate asset prices by improving U.S. fundamentals.
Meanwhile, let me ask you about the Fed, Mohamed. The Federal Reserve obviously announcing yesterday it's going to start reducing that massive $4.5 trillion portfolio of bonds and securities next month. That's a decade after the biggest financial crisis in generations. Chairwoman Janet Yellen called the move a vote of confidence in the economy. Here's what she said yesterday. Basically that, look, the economy is doing well and we should start doing this. But this is something we haven't seen before, Mohamed, this winding down of $4.5 trillion portfolio. How easy is this going to be?
So the Fed intends to make it as unexciting as possible. They really wanted to make it as if we are going to watch paint dry. Dull, predictable, that's how they want to make it. And I think they're going to succeed because they're going to go so slow. More interesting, Maria, is that the Fed continues to signal higher interest rates than what's priced into markets. And we saw some reaction yesterday. Bond yields have gone up. The dollar has strengthened as markets are starting to realize that the Fed still has a December rate hike on its radar screen.
Yeah, and I think that signaled that yesterday. Is that the right course, Mohamed? Another interest rate hike in December? Because as I just mentioned, I know things have gotten better, but sometimes it's two steps forward, one step back. I mean, does higher rates crash or slow down an economy that is just beginning to gain traction?
I don't think they crashed the economy. I also don't think they slowed the economy. Why? I think that there is momentum in this economy, not great momentum, but strong enough momentum. There's potential upside if we get tax reform done. So when the Fed looks at its two mandates, it gets a green light from the employment mandate. It gets a flashing yellow light from inflation because it believes inflation is too low, well below its target of 2%. But it also has to think about financial stability. So when I put these three things together, I would urge a rate hike in December as opposed to a wait-and-see attitude.
All right. Meanwhile, look around the world for us, Mohamed. S&P today cutting its credit rating for China. First time they're cutting the credit rating since 1999. They're talking about risks from the soaring debt the country faces. This is the second downgrade by a major ratings company this year. What's your take on the move, and would you be putting money today in emerging markets, including China, Europe? Look around the world for us.
So first, the China downgrade shouldn't come as a great surprise to markets. Why? Because, like you said, Moody's moved earlier a few months ago, and everybody was expecting S&P to follow. But it is a signal to the Chinese politicians ahead of a very important gathering that they have to take seriously their growth model. They can no longer depend on credit and debt to power this economy forward. So it's a very strong message within China, not a great surprise to markets. As opposed to what investors should do, a few weeks and months ago, I was on your show and I kept on saying the key thing is to get exposure elsewhere, internationally. And that has been the right call. Now, unfortunately, it's not as easy a call because emerging markets have done extremely well. I think right now, one has to look at these valuations and start thinking, maybe at this point, I should take some cash off the market, not a lot of cash, but some cash off, and wait for a better entry point.
Yeah, it's interesting how well the international markets have done. Do you feel that way in the U.S. as well, Mohamed? We know this market's up better than 20% since the election. Valuations around 18 times earnings. Would you buy U.S. stocks today?
Depends what my starting point is, but I join the many professionals who look at this market and say, we understand why it has done so well, and it's great that so many people have benefited, but at some point you've got to validate these asset prices through better fundamentals. And ultimately it goes back to what we started on. It's a political call. It's about the ability of Congress and the administration to get tax reform done, to step up infrastructure, and to continue on deregulation.
Yeah, we're all watching that for sure. And real quick on the dollar, Mohamed, you mentioned earlier the dollar has begun to rise again. It's obviously had a tough year. The euro was soaring earlier in the year. What's your take on the dollar and the continued sustained strength here?
So ironically, the tough year for the dollar, which means the weaker dollar, has been good for the economy and good for the stock market. Why? Because companies earn from selling abroad, and the weaker the dollar, the more competitive they are. Having said that, my major concern is that the system as a whole doesn't accommodate a strong currency. So for Europe, it's not great news that the euro has been strengthening. It's like a hot potato. No one wants a stronger currency. So one has to keep an eye not on the U.S. The U.S. is fine, but on how you add up a global economy that's not strong enough to support a very appreciated currency.
Yeah, that makes a lot of sense. Mohamed, it's always a pleasure to see you, sir. Thanks so much.
Thank you, Maria.
Mohamed El-Erian joining us there.